The S&P 500 just closed its eighth straight winning week. The Dow hit a new all-time high. The stock market is on fire. And on the exact same day, American consumer sentiment collapsed to the lowest level since 1952. That's not a typo. 1952, the year the survey was invented. Americans have never felt this bad about the economy. So who's wrong? Wall Street or the average American? Because they can't both be right. Let me show you what's actually happening. This is the kind of divergence that almost never happens in financial history. And when it does, it usually ends one way. First, the numbers, because this story only makes sense when you see them side by side. On Friday, May 22nd, the S&P 500 closed at 7,473. The Dow Jones hit a fresh record at 50,579. The S&P is up about 9% year to date. 8 straight weeks of gains, the longest winning streak since December 2023. On the exact same day, the University of Michigan released its monthly consumer sentiment survey. The reading came in at 44.8. To give you a sense of how bad that is, the previous all-time low was about 50, hit during the inflation spike of June 2022. Before that, the worst readings on record were in the early 1980s during stagflation. 44.8 doesn't just break the record, it demolishes it. So here's the picture. Markets at record highs. American consumers more pessimistic than they have ever been in 74 years of recorded data. Now let's break down why this matters, because if you don't know what this sentiment number actually measures, the rest of the story doesn't land. The Michigan Consumer Sentiment Index is an economic survey that's been running since November 1952. Every month, the University of Michigan asks about 600 American households 3 simple questions. How do you feel about your finances? How do you feel about the economy today? How do you think things will go over the next year? Sounds simple, but here's why it's one of the most powerful economic indicators on the planet. Reason 1. Consumer spending is roughly 70% of the entire U.S. economy. If Americans stop buying, the economy stops growing. Companies lose revenue, stocks fall. There's no way around it. Reason 2. Sentiment is what we call a leading indicator. People cut back on spending 3 to 6 months before the economic data shows the slowdown. So when sentiment collapses, it's telling you what's going to happen, not what already happened. Reason 3. Historically, every time this index has fallen below 60, the stock market has corrected within 12 months. Every single time. We're now sitting at 44.8. But here's the nuance most analysts miss. Sentiment is also a contrarian indicator over very long time frames. Buying when everyone is terrified has historically produced excellent returns. The catch? Usually the market corrects first, and the rebound comes after. So 44.8 is not noise, it's a signal. The deepest signal of consumer distress in 74 years of recorded American economic history. Now the question is why? Why are Americans this terrified right now? The answer is more specific than you might think. The trigger isn't mysterious. It's geopolitics colliding with economics, specifically the conflict in the Strait of Hormuz. For listeners who haven't been following the geopolitical news, about 20% of the world's oil passes through that narrow shipping lane between Iran and the Arabian Peninsula. When supply gets disrupted there, oil prices spike. Globally, within hours. That's exactly what's happening. Oil prices are up, gasoline prices at the pump have spiked, and here's the part that drives the sentiment number down. When Americans fill up their car and see the bill, that's the most visible inflation they experience in real time. It's in their face. Every week. 57% of consumers in the Michigan survey spontaneously mentioned high prices as eroding their personal finances. Up from 50% just a month ago. This isn't an abstract worry. It's a paycheck-level problem. And it's not just today. Consumers expect inflation to keep rising. The 12-month inflation expectation hit 4.8%. The long-term expectation jumped to 3.9%. Both are way above the Federal Reserve's 2% target. Why does this matter for the markets? Because expected inflation is just as important as actual inflation. If consumers expect prices to keep rising, they demand higher wages. Companies pass those costs back to consumers, and the inflation cycle becomes self-sustaining. So now you understand the picture for the average American. Oil and gas costs surging, inflation expectations rising, wages not keeping up, sentiment at historic lows. The question becomes, why on earth is the stock market hitting record highs in the middle of all this? There are 3 reasons Wall Street is going up while Main Street is in pain. They're worth understanding because they explain almost every market right now. Reason 1. Corporate earnings are still strong. Why? Because when inflation hits, big companies pass the cost on to consumers. The consumer pays more, but the company keeps its profit margin. So even as people suffer, the companies they buy from keep making money. Reason 2. Liquidity is still flowing. Passive investments like 401k plans and ETFs keep buying stocks every month, automatically, no matter what the news says. That mechanical buying supports prices even when sentiment crashes. Reason 3. Markets are pricing in a Federal Reserve pivot. The new Fed chair was just sworn in. Wall Street believes rate cuts are coming soon, which would lower borrowing costs and boost asset prices. So investors are buying ahead of what they expect. So Wall Street isn't blind. It's looking at a different set of numbers than Main Street: corporate earnings, future Fed policy, and passive money flows. The pain of the average household? That's just not in their model. But here's the catch. Eventually, the two must reconcile. The market cannot keep rising forever on corporate margins while the consumer underneath it is broke. History is brutal about this lesson, and the reconciliation could start this very week. 3 major economic data releases hit in just 3 days. Each one could shift the balance. Tuesday brought consumer confidence and Case-Shiller housing prices. Both showed pressure. But the big one is Thursday, PCE inflation. This is the specific inflation measure that the Federal Reserve actually uses to decide on rate policy, not CPI. PC. If PCE comes in hotter than expected, the Fed pivot story dies overnight. Rate cuts get delayed or canceled. The whole reason Wall Street is buying disappears. Stocks could drop fast. If PCE comes in cool, the pivot story holds. Wall Street keeps rallying. The divergence continues. Friday brings personal income, personal spending, and Chicago PMI. Confirmation or denial. This is one of those weeks where the data actually matters. And the timing is brutal. The market is at record highs, sentiment is at record lows, and the catalysts are sitting in the calendar for the next 48 hours. So you know the picture. Now the real question, what can you actually do with this information? Maybe you're already investing. Maybe you've been waiting to start. Maybe you're somewhere in between. Either way, here are 4 practical scenarios. Scenario A, you've never invested before. The temptation when markets are at all-time highs is to think you've missed the train. The data actually suggests the opposite. Starting when everyone is euphoric is historically the worst timing. The classic approach for someone just starting is dollar cost averaging. You commit to buying a fixed amount every month, automatically, regardless of where the market is. If prices fall, you buy more shares for the same dollars. If prices rise, you buy fewer. Over years, this smooths out timing risk. Start with a globally diversified ETF, not a single stock. Scenario B, you invest already, but you're 100% in stocks. The honest question is, if the market drops 20% tomorrow, what do you do? If your answer is, I'd panic and sell, you're too concentrated. The classic diversification is 60% stocks, 40% bonds. The closer you are to needing the money, the more protection you should have. Scenario C, you invest and you're already diversified. The question isn't sell or hold, it's rebalance. Stocks have risen a lot, which means they now weigh more in your portfolio than you planned. Sell a small portion of what's risen, buy what's lagged. That's not market timing, it's discipline. Scenario D, you have cash sitting on the side waiting for the perfect dip. The temptation is to wait for the crash and buy at the bottom. The reality is nobody knows when the bottom is. Even if a correction comes, it could be 5% or 30%. The smarter approach for sideline cash is staged entry. Divide the total you want to invest into 6 or 12 monthly tranches. If the market corrects, you have dry powder ready. If it keeps rising, at least you're participating. Either way, you avoid the worst outcome, which is missing it entirely or going all in at the peak. What none of these scenarios includes: putting everything into a single stock, trying to time the bottom exactly, trading on emotion when the news cycle gets loud. The data we just looked at is meant to inform your thinking, not panic you into action. None of these are recommendations, they're frameworks. The point is that you now have the context to make a conscious choice, instead of reacting to whatever the next headline tells you. Before we wrap, the honest reality check. Markets can stay irrational longer than most investors can stay solvent. That's an old quote that exists for a reason. Sentiment has been near record lows for months. Goldman has been warning about correction for years. Sometimes the warning is right, sometimes the rally just keeps going. But 44.8 on the Consumer Sentiment Index isn't background noise. It's the lowest reading in 74 years. The data is real. The gap between markets and Main Street is real. And one of the two has to give. The only question is when. Thursday's PCE inflation print could be the first major clue this week. Friday's personal income and spending data will confirm or deny it. By the weekend, we'll have a much clearer picture of which side of this divergence is winning. Markets or Main Street. I'll be back with the analysis once those numbers are out. Subscribe so you don't miss it. And drop a comment with what you think is happening. Wall Street or Main Street, who is going to be right? I'll see you in the next one.